Good evening. Welcome to Kenya News Update today. I'm your host. Tonight, we're diving deep into a major infrastructure development that could reshape East Africa's economic landscape. Uganda wants to link a new railway line to Tanzania, opening up a new export route. This move has direct and significant implications for Kenya, which has long been Uganda's primary gateway to the sea. For the next 12 minutes, we'll unpack this strategic pivot, examine the numbers, and debate what it means for Kenya's own multi-billion-dollar standard gauge railway project. Let's get into it. Our top story: a government document obtained by Reuters reveals Uganda's intention to connect its new standard gauge railway, currently under construction, to a line being built in neighboring Tanzania. This would create an alternative southern corridor for Ugandan exports, primarily minerals like gold, copper, and iron ore. Currently, an estimated 95% of Uganda's commodity exports travel through Kenya via the port of Mombasa. This potential shift represents a direct challenge to Kenya's logistical dominance in the region. The proposed link would give landlocked Uganda a second, competitive option, reducing its reliance on the northern corridor through Kenya. This comes at a critical time. Kenya's own SGR, a flagship project of the previous administration, stretches from Mombasa to Naivasha. Its planned extension westward has faced significant financial and political hurdles. The question now is whether Uganda's southern gambit is a negotiating tactic, a genuine diversification strategy, or a signal of deeper regional tensions. To understand the stakes, we need to look at the numbers. The northern corridor, running from Mombasa through Nairobi to Kampala and beyond, handles over 4.5 million metric tons of cargo annually. Of that, Uganda accounts for approximately 1.8 million metric tons. That's nearly 40% of the corridor's total volume. This traffic is the lifeblood of Kenya's SGR and port operations, generating hundreds of millions of dollars in revenue each year. The potential loss of even a fraction of this cargo to a Tanzanian route would have serious financial repercussions. Furthermore, Kenya has invested heavily in port infrastructure at Mombasa, with a second container terminal operational since 2016 at a cost of 30 billion shillings. The port's capacity now stands at 1.65 million TEUs annually. A significant diversion of Ugandan traffic would mean underutilization of this capacity, turning an asset into a potential liability. Now, let's examine Uganda's perspective. Why would they seek an alternative route? Proponents argue it's simple economics and risk management. Relying on a single corridor through one neighbor creates vulnerability. Disruptions at the port of Mombasa, political disagreements, or congestion on the Kenyan SGR and road network can strangle Uganda's economy. A southern link through Tanzania to the port of Dar es Salaam offers redundancy. It also potentially offers shorter shipping times to key markets in southern Africa, the Middle East, and Asia for certain goods. Tanzania's port of Dar es Salaam has undergone its own expansion, now handling around 1.4 million TEUs per year. While currently smaller than Mombasa, it's a viable competitor. For Uganda, this isn't necessarily about abandoning Kenya, but about creating leverage and ensuring they have options. It's a classic move in logistics geopolitics: never put all your containers in one basket. However, this development must be viewed in the context of Kenya's own SGR saga. Our second source reveals critical insights from Treasury Cabinet Secretary John Mbadi. He stated this week that the government is pursuing creative financing options to extend the standard gauge railway from Naivasha to Kisumu and finally, to the Ugandan border at Malaba, without relying on new debt from China or other external lenders. The estimated cost for the Naivasha to Kisumu segment alone is a staggering $3.3 billion, or approximately 425.7 billion shillings. The full extension to Malaba would cost significantly more. This announcement of seeking alternative financing comes after years of stalled negotiations with China's Exim Bank, the primary financier of the existing SGR. The original loan for the Mombasa-Nairobi phase was $3.2 billion, with the Nairobi-Naivasha phase costing another $1.5 billion. Kenya's public debt stands at over 11 trillion shillings, making new large-scale borrowing politically and economically sensitive. So, we have a paradox. Uganda is looking to build a link away from Kenya's SGR network at the very moment Kenya is trying to finance an extension to reach Uganda. This timing is not coincidental. It suggests Uganda may be losing patience with the delays in the Kenyan extension. The Malaba border point is the logical connection for the Kenyan SGR to hook into Uganda's planned network. If Kenya's line stops at Naivasha, 400 kilometers short of the border, its utility to Uganda plummets. Uganda's Minister for Works and Transport has previously stated that their SGR project is shovel-ready, awaiting a clear connection plan. By opening talks with Tanzania, Uganda is sending a clear market signal to Kenya: finance and build your section, or we will find another partner. This is high-stakes infrastructure poker. Let's visualize the financial scale here. The cost of the Kenyan SGR extension to Kisumu is 425.7 billion shillings. Compare that to some of Kenya's other major budget items. The country's annual healthcare budget is around 140 billion shillings. The Roads Maintenance Fuel Levy Fund collects roughly 50 billion shillings per year. The SGR extension cost is equivalent to over 3 years of the entire healthcare budget. This underscores why financing is such a monumental challenge. Cabinet Secretary Mbadi's creative financing could involve public-private partnerships, pension fund investments, or syndicated local borrowing. However, mobilizing such a sum domestically would crowd out credit for the private sector. The alternative, external debt, is what the government claims it wants to avoid. This financing dilemma sits at the heart of Kenya's response to Uganda's southern maneuver. What are the potential impacts on Kenya if Uganda proceeds with the Tanzanian link? We can break it down into 3 areas: port traffic, SGR viability, and regional influence. First, port traffic. Mombasa could see a decline of 10 to 30% of its Ugandan transit cargo within 5 years of a southern link becoming operational. That translates to between 180,000 and 540,000 metric tons annually. For a port operating on thin margins, this loss of volume would hurt profitability and could lead to higher charges for remaining users, making Kenya less competitive. Second, SGR viability. The Kenyan SGR's economic case was built on high-volume, long-distance haulage. Losing the Ugandan traffic to the critical Kisumu and Malaba extensions would undermine the revenue projections for the entire line, potentially turning it into a white elephant. The SGR currently moves about 40 freight trains per week. Its break-even point requires consistent high utilization. Third, and perhaps most significant, is regional influence. Kenya has positioned itself as East Africa's trade and logistics hub. This position is not guaranteed. It is earned through efficient, cost-effective infrastructure. A successful Uganda-Tanzania link would empower the Central Corridor, making Dar es Salaam a rival hub to Mombasa. It could also encourage other landlocked neighbors, like Rwanda and Burundi, to consider diversifying their routes. This would fragment the East African community's logistics market and dilute Kenya's strategic clout. The political ramifications within the EAC would be substantial, potentially shifting the balance of power in regional trade negotiations. But is this all a done deal? Not necessarily. There are major hurdles for the Uganda-Tanzania plan. Tanzania's SGR project, being built in phases, is itself a massive undertaking. Its standard gauge may not be immediately compatible with Uganda's planned specifications, requiring costly adjustments. The terrain between the two countries is challenging. Furthermore, the port of Dar es Salaam, while expanding, has historically faced efficiency issues compared to Mombasa, with longer average ship turnaround times. The distance from Kampala to Dar es Salaam is also greater than to Mombasa, increasing inland transport costs. These factors mean the southern route may not be cheaper or faster, merely different. Uganda's move might be primarily a strategic play to pressure Kenya into faster action on the Malaba link and to secure more favorable transit terms on the northern corridor. This brings us to the debate. On one side, analysts argue Kenya should view this as a wake-up call. It must accelerate its SGR extension through innovative financing, perhaps even offering Uganda a stake in the project to ensure buy-in. Simultaneously, Kenya must double down on improving the efficiency and reducing the cost of the Mombasa corridor to remain the undisputed best option. On the other side, some experts suggest Kenya should call Uganda's bluff. They argue that the economics still favor Mombasa and that building a redundant southern line is a wasteful duplication of infrastructure for Uganda. Instead, Kenya should focus on integrating its SGR with the existing meter gauge railway and improving last-mile connectivity to the port, making the total journey seamless. There's also a third perspective, one of regional collaboration. Perhaps this isn't a zero-sum game. Could there be a tripartite agreement where Kenya, Uganda, and Tanzania harmonized their railway gauges, tariffs, and operations to create a seamless East African rail network, a network where cargo can flow efficiently north-south and east-west, using the best ports for different destination markets. This would require unprecedented political will and technical coordination, but it would maximize the benefit for the entire region. The East African Community's Common Market Protocol envisions such integration, but it has been slow in implementation, especially in transport. Looking ahead, the next 6 to 12 months will be critical. Kenya's Treasury must present a credible, detailed financing plan for the SGR extension. Uganda will be watching closely. If credible progress is made, the Tanzanian link may remain a secondary, backup plan. If not, Uganda will likely accelerate its southern negotiations. The outcome will shape East African trade for decades. It will influence where billions of dollars in infrastructure investment flows, which ports grow, and which economies capture the value-added services of logistics and forwarding. In our final minute, let's consider the human and business impact. For Kenyan trucking companies that carry the bulk of Uganda-bound goods from Naivasha onward, a southern shift would mean lost business. For communities along the proposed Kenyan SGR extension route, like Kisumu, it could mean delayed or lost development opportunities. For Kenyan consumers, the health of the port and SGR affects the final cost of imports. This is not just a story of governments and railways. It's about jobs, prices, and regional development. Kenya's response must therefore be nuanced, strategic, and swift. Ultimately, Uganda's desire for a Tanzanian link is a powerful reminder that in global trade, connectivity is sovereignty. Countries will relentlessly seek the most reliable and cost-effective routes to market. Kenya's hub status is a tremendous asset, but it is not a right. It must be continually earned through competitive infrastructure, efficient services, and reliable partnership. The ball is now in Kenya's court. How it plays its hand on SGR financing will determine whether the Northern Corridor strengthens or whether we see the rise of a powerful Southern rival. That's our deep dive for this evening. A complex story of infrastructure, finance, and regional rivalry with profound implications for Kenya's economic future. We'll continue to follow this story closely. For now, thank you for watching. Subscribe to Kenya News Update today for more in-depth reporting. Good night.